Chart of accounts tax impact. A CPA just called me about a client who's going to overpay their taxes by at least $8,000 this year. The problem? Their chart of accounts is structured wrong, and legitimate deductions are getting lost in the wrong categories. And this happens constantly. I'm Bev from bookkeepingcoach.net. In 30 years of bookkeeping, I've reviewed hundreds of chart of accounts setups. And right now, in mid-February, CPAs are preparing tax returns and discovering that their clients' chart of accounts are costing them thousands in taxes. Let me tell you about this specific case because it's a perfect example of how your chart of accounts structure directly affects your tax bill. This is a professional services business, a consulting firm, about $650,000 in annual revenue. They've been using QuickBooks for 3 years. They enter all their expenses, they reconcile their accounts, they think their bookkeeping is fine. Their CPA is preparing their 2025 tax return right now. He pulls up the profit and loss statement and immediately sees problems. First issue, they have one massive category called operating expenses that has $127,000 in it. That's nearly 20% of their revenue in one vague category. The CPA can't tell what any of those expenses actually are. Are they deductible? Are some of them personal? Are some of them capital expenses that should be depreciated instead of expensed? He calls the business owner. I need you to send me a detailed breakdown of what's in operating expenses. The business owner exports the transaction detail. It's 340 line items: client meals, software subscriptions, office supplies, professional development courses, marketing expenses, travel, equipment repairs, conference fees, everything imaginable, all dumped into one category. The CPA now has to go through 340 transactions and manually categorize them correctly for tax purposes. At $325 an hour, this is going to add 8 to 10 hours to the tax preparation bill. That's an extra $2,600 to $3,250 in fees, but that's just the beginning. The real problem is what the CPA discovers when he starts categorizing those expenses. The second issue, $18,400 in legitimate vehicle expenses were coded to operating expenses instead of having their own vehicle expense category. Because of this, the CPA almost missed them completely. Vehicle expenses can be significant deductions, and they need to be tracked separately. The third issue, $6,800 in continuing education and professional development, was scattered across 3 different categories: operating expenses, subscriptions, and miscellaneous. The CPA had to dig through everything to find these deductible education expenses. The fourth issue, $12,300 in meals and entertainment, was all lumped together with no distinction between client meals, which are 50% deductible, and employee meals, which are sometimes 100% deductible depending on the circumstances. The CPA has to guess at the split, which means the business might not be getting the full deduction they're entitled to. The fifth issue, $4,200 in home office expenses, wasn't tracked separately. It was mixed in with other facility costs. The home office deduction requires specific documentation and calculation. Because it wasn't set up properly in the chart of accounts, the business owner can't easily prove what their home office expenses actually were. The sixth issue, software purchases totaling $8,900, were split between computer expenses, subscriptions, operating expenses, and even office supplies. Some of these should be expensed immediately. Others should be capitalized and depreciated. The CPA can't tell which is which without investigating each transaction. After the CPA spends hours recategorizing everything, here's what he discovers. Because expenses were in the wrong categories, the business owner has been making bad business decisions all year. They thought their marketing expenses were only $8,000, when they were actually $23,000. They thought they were spending $3,000 on software when it was actually $8,900. But worse, when the CPA prepares the tax return with everything properly categorized, he finds that some expenses were completely missed. Between the vehicle expenses, that were nearly overlooked, the education expenses that were scattered, and the home office that wasn't properly documented, the business is going to miss out on approximately $8,000 in legitimate deductions. At a 25% tax rate, that's $2,000 in extra taxes paid, plus the $2,600 to $3,250 in extra accounting fees to clean everything up. Total unnecessary cost, $4,600 to $5,250, all because the chart of accounts wasn't structured correctly for tax optimization. And here's the worst part. This same problem will happen again next year unless the chart of accounts is fixed. So this business is looking at $4,600 in extra costs every single year going forward. So let's talk about what a properly structured chart of accounts needs to look like for tax optimization. First, you need specific categories for major expense types the IRS looks for on tax returns. There are 17 specific categories that appear on business tax returns. Your chart of accounts should have clear categories that map to these tax form lines. For example, advertising, vehicle expenses, commissions, depreciation, employee benefits, insurance, legal and professional fees, office expenses, rent, repairs and maintenance, supplies, travel, meals, utilities, and wages. These need to be separate categories, not all lumped into operating expenses. Second, you need separate expenses that have different tax treatments. Meals with clients are 50% deductible. Employee meals during business travel might be 100% deductible. Personal meals aren't deductible at all. These need to be in different categories so your CPA can apply the correct tax treatment to them. Third, vehicle expenses need their own tracking structure. If you're using the actual expense method, you need categories for gas, insurance, repairs, registration, depreciation. If you're using the mileage method, you still need to track these expenses separately for AMT purposes. Fourth, home office expenses need to be tracked in a way that makes the calculation clear. If you're using the simplified method, you need square footage documentation. If you're using the actual expense method, you need to track the business percentage of your mortgage or rent, utilities, insurance, repairs, and depreciation. Fifth, assets need to be separated from expenses. Equipment purchases over certain thresholds should be coded to asset accounts and then depreciated, not expensed immediately. Your chart of accounts needs clear asset categories. Sixth, you need to separate direct costs from indirect costs. For businesses that track cost of goods sold or direct project costs, these need to be in separate categories from overhead expenses. This affects how your gross margin is calculated. Seventh, you need enough detail to make business decisions, but not so much detail that categorization becomes difficult. There's a balance. Having 400 expense categories is way too many, but having 5 is too few. And 8, your chart of accounts needs to match how your CPA wants to see information for tax preparation. If your CPA has to spend hours recategorizing everything, that's a sign your chart of accounts is not structured correctly. There are 12 other considerations for chart of accounts structure depending on your business type, but these are the 8 that cause the most tax-related problems. And here's what business owners don't realize. QuickBooks gives you a default chart of accounts when you set it up. It's generic. It is not optimized for your specific business or for tax reporting. If you just use the default and start entering transactions, you're gonna end up with the same mess this consulting firm has. Your chart of accounts is the foundation of your financial reporting. If it's wrong, everything built on it is wrong. Your profit and loss statement doesn't give you accurate information. Your tax return doesn't capture all of your deductions. Your business decisions are based on incomplete data. So if you're not sure whether your chart of accounts is structured correctly, what are your options? Well, option 1 is keep using what you have and hope your CPA can figure it out. This works sometimes, but it costs you extra in accounting fees every year, and you're probably missing deductions. Option 2, try to restructure it yourself. This works if you understand tax reporting requirements and you know what categories you need. Most business owners do not have this knowledge. Option 3, have someone who understands both bookkeeping and tax requirements review your chart of accounts and restructure it for tax optimization. The worst option is to know your chart of accounts is messy and just keep using it because changing it seems hard. Every year you wait is another year of extra accounting fees and missed deductions. If you're not confident in your chart of accounts is optimized for tax reporting, I can help you evaluate it and restructure it if needed. I do chart of accounts reviews where I look at your current structure, identify what's causing problems for tax reporting, and create a plan to reorganize it correctly. The goal is to make sure you're capturing all your legitimate deductions and your CPA can efficiently prepare your return. This is especially important right now in mid-February because your CPA is preparing your 2025 return. If they're finding issues with how your chart of accounts is structured, now is the time to fix it before you file. I've put a link in the description below where you can book a call with me. We'll review your current chart of accounts, identify any tax-related issues, and figure out what needs to be restructured. Stop overpaying taxes and extra accounting fees because your categories are wrong. The link is in the description to book a call. Your chart of accounts seems like a boring technical detail, but it directly affects your tax bill and your accounting fees every single year. A well-structured chart of accounts saves you money in 2 ways. You capture all of your legitimate deductions, and your CPA doesn't have to spend hours recategorizing everything. This consulting firm is going to pay an extra $4,600 this year because their chart of accounts is wrong, and next year, and the year after that, unless they fix it. Subscribe to the channel for more tax optimization and bookkeeping tips. The link in the description is if you want your chart of accounts reviewed. I'll see you in the next video.